Hello everyone, welcome back to our Accounting 312. In this video, we will talk about the second method. Last time we talked about net present value. We said the main thing is we consider all the cash flows and then we discount all them to the present value, then we find the net. We also talk about if the NPV is equals to or larger than 0, we will take the project, and then we also talk about other factors managers have to consider. So this time we talk about internal rate of return, IRR. I personally think IRR takes a little while to think through, but once you understand it, you will get it. So let's get started. IRR is the cousin, is the sibling of NPV. They both rely on discounted cash flow. Okay, so put that in your mind. So IRR and NPV most of the time they will reach the same conclusion, but we will say NPV has better has that advantage compared with IRR. So what's the meaning of internal rate of return? What's the meaning? So rate of return, you know, it's a percentage, it's a rate, 5%, 10%, 11%. But what's the meaning of internal rate of return? Okay, so now let's think about this example. Okay, as remember I said you want to borrow $1 million from the bank, right? You want to borrow $1 million from the bank. Okay, so now you borrowed $1 million, $1 million from the bank. A bank said, oh, I'm not going to give you for free, so you have to give me 10% at the interest. So this 10% is your company level, right? So no matter what company does, you know, you invest what you will give the how many departments you have. Let's say it's funny is the company overall will give 10% to the bank. So the 10% we said is the required rate of return, right? The required rate of return. Okay, so now once the company gets this $1 million, let's say it has 3 different projects or 3 departments, they invest each different project. So you have one is the gas station, okay, gas station. And then second is you have ice cream, okay, ice cream, because I like ice cream. And then third one is you have apartment, okay, you want to rent to SIU student. Okay, now you have 3 departments, you have 3 choices or whatever. You use this 10%, you borrow from the bank and you invest in 3 projects. What are the internal rate of return for each specific project? So for gas station, let's say you do all the calculation, you find out the gas station itself, the internal rate of return for gas station project, for gas station department is 12%. Let's say, oh, if the gas station department, gas station, this project got 12%, that 12% is the internal rate of return. It's the internal rate of your each specific project. So your IRR focuses on the company level and IRR focuses on each specific project, the internal project rate of return. And then you do the same analysis, you find out ice cream gives you 10%, apartment gives you 8%. So this is each project IRR. This is each project IRR. How do you get that one? We will learn how to calculate the IRR. So first thing you know is IRR relies on each specific project. And second, remember we said IRR is the cousin of NPV, right? So it definitely is related with our NPV. And then it's also related with our IRR. I ask you a question. You borrow money at 10% from the bank. And you use the money you invested in gas station, this specific project, and the IRR is 12%. You borrow that 10%, this project give you the return as 12%. I ask you a question, what's the project NPV? Positive or negative or 0? You say, oh, straightforward, right? The NPV for this project, the NPV for this project will be positive because your project return is higher than your company required return. Your project for ice cream, you borrowed 10%, you also got 10% back. What's your NPV? Our NPV is 0. You borrowed 10%, you got 10% back. Basically, break even, right? Break even. Oh yeah, apartment. You borrowed 10%. Your return for this project, IRR, is 8%. What will happen? NPV is negative. Did you see what I'm trying to link everything together? Okay, so first thing we said, our law or our rule is, how do we think about, we take this project, yes or no? We said that the IRR has to be at least, sorry, my bad, has to be at least the same or larger than the RRR. At least like the ice cream, you borrow that 10%, you have at least 10% back, right? So apartment, we declined. Your IRR 8% is lower than RRR. I ask you, hey, stop. Hey, my student, do you understand this? Yes or no? Oh, I understand. Good. Second thing, how do we link our IRR with NPV? I ask you a question. If IRR is larger than RRR, what does this suggesting to your NPV? Your NPV will be positive. Your NPV will be positive. I tell you here, but in the exam, what most likely I will ask you. IRR is smaller than RRR. Your NPV will be negative. Okay, your NPV will be negative. Does this make sense? Yes or no? You got it. You got 50%. You got the most important part of IRR. I stop here. Actually, I know it's a short video. I stop here because I really want you to, hey, stop, watch this video, read your textbook, get the feeling, get the understanding of this IRR thing. How do we compare RR with RRR? And then if this relationship, what will imply to our NPV? Okay, short video. Let me know if you have any question. I see you next one. We will talk about how do we calculate IRR. See you next time.